Friends, welcome to this very interesting video on the theme Preparing Financial Statements in a Novel Way as a part of our series Finance and Investing Tidbits. This video is going to be very useful for those who don't have any accounting and finance background and those who are keen to know how financial statements emerge in the first place. Many people are interested in interpreting financial statements, but they don't know how the financial statements arise from raw transactions. So friends, this is a fantastic video for those who want to really know the building blocks of these financial statements. If you want to interpret them, it's very important that you know how this data gets handled and gets grouped and gets summarized and gets presented. So it's absolutely useful for all those who have that curiosity. Welcome to this video. Let me share with you a story how I thought of this idea. So this happened about 16 or 17 years ago, either in late 2004 or early 2005. One evening I got a frantic call from a reputed school of management with which I was also earlier associated as a visiting faculty, particularly for their 3-year Master of Management program, which was meant for working professionals. I continue to remain associated with them for some of the corporate interventions. So the call was to come and help out to take a session for employees of one of the largest FMCG companies in India. This was to be on the second day. The first day was already engaged by another faculty. I'm not sure whether it was an internal faculty or another external faculty, but apparently the session did not go very well. And the session was all over the place. So now I had no clue of what had been covered, and it would have been an offense to ask the faculty member what was done, because obviously that faculty member must have been slated to take the session on day 2 as well, but somehow had to withdraw. So I had to take up something which would be novel and would not have been covered on day 1 for sure. And I had to create a wow moment because I had to also bring the program on track. So it was like an onerous responsibility. And I had just a couple of hours on my hand to change the mood of the audience. So I thought of doing an exercise to construct financial statements using simple logic. It worked like a miracle. So a lot of concepts which were discussed on day 1 suddenly got connected with this exercise. And I then used this method in all my programs where time permitted to do so. I pioneered fundamentals of finance offering on behalf of a subsidiary of a very reputed American firm who launched education business here. And I ran public courses in all the major metro cities and mini metro cities. I would remember about 20 such programs which were available to anyone by subscription. Now it is quite likely that because I was associated with them for a couple of years, and obviously later on they employed their own people to make it more cost effective. And I'm sure they would have, having attended my sessions, they may have also continued to use this method. But I must say that I have been a pioneer of this method, and I wanted to put it in the public domain. So in some other courses also where participants who had finance background, who had academic responsibilities of teaching such courses, who attended, I'm sure would have also liked the method and followed in their own pedagogy. However, I claim to be the pioneer, and I think anyone who wants to use this method rightfully could ascribe it to me and call it as, say, Fadnis method. I'll be very happy to see that happening. But of course, we know that people like to use others' methods, but not necessarily give due credit. So I wouldn't be surprised if somebody is doing that without obviously seeking my concurrence. But that's fine, and I don't worry about that. And in fact, some people who are going to listen to this, they want to use this method in their own teaching pedagogy. Obviously feel free. Just think of giving a credit to somebody who pioneered it. Okay, so welcome to this video. It's going to be very interesting because in my own courses which I teach, unless I'm teaching a formal accounting course, whenever I'm engaging business audiences, I never use the language of debit and credit. I explain concepts using simple logic, and that's what I'm going to do here. And with your participation, I'm going to do an example along with you, jointly with you, sharing with you some data, and you can also download a few things after I tell you to do so. You can also construct financial statements along with me. So welcome to this interesting journey. Fasten your seat belts for next hour and a half. But I can promise you it's going to be fascinating and interesting. And it will also help you to connect a lot of your dots, whatever gaps you may have had while reading financial statements, I can assure you that. And do give your comments and feedback in the comments section, because that is something which will be very vital. For professionals who come from accounting and finance stream, this method would also be a bit of a shocker, since the way they have learned accounting and the way they have learned preparing financial statements, typically the focus is on statement of profit and loss and balance sheet alone, right? The cash flow statement usually is relegated to the background, and it is just treated as a bank book from their perspective. But in this method that you're going to experience, I have also brought cash flow statement right up front. Now this cash flow statement is nothing else but a direct method of presenting inflows and outflows. Those of you who have accounting background, there is an indirect method of deriving cash flows. Right now I don't want to get into that. That indirect method is something I'll just touch upon at a later stage of this video, but here I'm going to follow a direct method. And the objective of this is to give you a holistic perspective of how these three financial statements are interconnected. So before I actually take you to the financial statements, I also want to talk quickly about some logical aspects of this, as well as the typical give and take that happens in the real world. So be patient and enjoy the process. Happy learning. So very quickly, and I have detailed videos on these, so those of you who are interested are most welcome to explore my detailed videos on these. Here I'm going to do it very brief, because in case somebody is landing on this video without having seen my other detailed videos in my series Learning Finance. So this is quick revision for those who have already seen those videos and those who have not had a chance to see them as yet. This is a very quick overview. So accounting and financial statements revolve only around 7 ideas, and the 7 ideas can be simply derived from the simple relationship of sources of funds and resources. So any business requires resources. It could be plant, machinery, equipment, it could be office space, it could be laptops, it could be various kinds of resources. So resources are required for any business, or in banking and NBFC kind of businesses, you simply require money because you need to lend, right? So you require resources for a business, but because you can't print money as a company, you need to source that money from people who have that money, and therefore money is sourced from sources of funds. Broadly, sources of funds are either equity or liabilities. Equity indicates people who are willing to take risk on that business, are willing to invest in shares of the company, are not really keen to get a defined return, but are very happy to participate in the progress of the company and take advantage of increasing dividend potential. So they are the equity owners, and people who lend money, as well as people give credit while giving goods or services, are indirectly financing the business. So you have lenders who are directly financing, and you have vendors and employees who are indirectly financing. But to the extent you have not paid them off, they also create what is called as a liability for the business. So equity and liabilities become the source of funds. Some direct, some indirect, but nonetheless, they are the sources of funds. You can see more detailed videos that I have already created in the Learning Finance series. Now these resources which are acquired by the business can be those which have not been fully consumed and which will continue to remain useful for a period of time. For example, you have set up plant and machinery. This will be useful over many years, right? You have acquired an aircraft as a part of your own airline business, as a scheduled airline. That aircraft is going to be used for many years, right? Or you have constructed an office space. These are resources as well, but they are not yet consumed fully. and they continue to have economic value which can be then put to use. So those can be called as assets. And then you also have resources which are getting consumed quickly. Even a part of these assets is also getting consumed gradually, and we call that as depreciation. Again, see my videos on that, right? So resources which are getting consumed are called as expenses, but we don't consume expenses just for the sake of it. We consume them to generate goods and services which can be sold to the customers, and that generates revenue from operations or income for the business. In addition, there could be other minor incomes like scrap sales, or the company is investing surplus money in deposits or investing in shares and they're getting interest or dividend. That will be non-core income. So again, I have dealt with all these issues in detail in other videos. Here I'm just introducing that framework of 7 ideas just as a refresher, right? So we have dealt with 5 of them. Now we'll also see that there is an inflow of money and an outflow of money. So when we source money from shareholders or from lenders, or when we sell goods and we get money from the customers, there is an inflow, you can see at the bottom. And when we acquire assets or we pay for expenses, there is an outflow. So essentially, there are these 7 ideas which are critical in understanding financial statements. So let us have one-line definitions of these concepts for ready reference. Equity is simply the money put in by business owners and which is enhanced from time to time by the profits earned from year to year, which is not yet distributed back to the shareholders. So that builds equity of a business. Liabilities are the amounts due to the lenders, vendors, employees, government till that amount is paid off. Once it is paid off, it doesn't remain a liability, right? The third are assets, resources which have value. They could be physical assets like plant and machinery, equipment. They could be intellectual assets which include know-how, intellectual property, brands, right? All those kinds of things. And then you could also have financial assets where you have a stake in another company, you have money in your bank account, your money in the form of cash. All these are financial assets. Income is what we charge to customers, and also incidental non-core income and gains that we earn as a part of our business. Expenses, as I've already mentioned, resources consumed in the course of business, and sometimes even losses happen, and losses are also reported along with expenses. Then inflow actually means money actually getting collected from customers, or we borrowing money from lenders, or we taking money from equity owners, or by sale of investments, right? So that causes inflow. Similarly, we get dividends and interest or rent on our investment. That also causes inflow. Money comes into our bank account. And similarly, there could be outflow, money which is paid to vendors, employees, lenders, equity owners for new investment. So these are very quick one-liner definitions. You can of course explore detailed videos, but keep this in mind that sometimes people confuse between income and inflow. Inflow is a much wider term. Inflow can be by even borrowing money, but that's not our income, right? Or it can be by sale of investments. That's not our income. Just like in our own passbook, we get credits for our salary, but we also get credits when we sell any of our investments or when we take a personal loan, right? So all inflow is not income. Similarly, income is recorded based on the contractual fulfillment and delivery to the customer, but inflow is actually receipt of money. So there could be a timing gap there also. So look at those nuances, and perhaps they will become also clear to you as I take more examples. So very quickly, I'll not repeat these one-liners, we have already defined them, but income, expenses, inflows, outflows are always measured for a period. So like even expressing our own personal salary, we say CTC, which is cost to company for a year, right? Similarly, rent is for a month. The inflow of money happens during a particular period. Outflow happens during a particular period. So income, expenses, inflow, outflow are measured for a period. And that's how they are reported. So you report sales for a quarter, sales for a month, sales for a year, salary for a year, salary for a month, salary for a quarter. Similarly, inflow for a year, inflow for a quarter, right? But when it comes to reporting assets, equity, and liabilities, we report with reference to a point of time. So they are more a matter of fact. They exist. Whether they exist at a particular point of time is really the test of recognizing something as an asset. So if I'm reporting an asset as on say 31st of March of a financial year, and that asset was sold on 29th of March, then obviously on 31st March, it doesn't exist, right? So basically, therefore, while reporting the asset, what is relevant is whether it exists at that point of time, which is the day of reporting, right? And in fact, a specific moment of reporting, which is the last moment of the day on which we are generating the report. So they are reported at a point of time. So these ideas again, we can talk about them as income, expense, and inflow, outflow are flow data. Imagine a river, right? It's like a flow. Water is flowing through it. Imagine looking at a video film or a film. It's the information is flowing, right? But when you look at a reservoir of water or a lake, the water is like stock, right? It exists and you can measure the quantity at a particular point of time, right? So inventory also means stock, but stock as an idea will apply to assets, equity, and liabilities alike. So what is the stock of a particular liability that exists on a particular day, and in fact, as I mentioned earlier, at a specific point of time? That is something which is what matters. So these are stock data. Just keep those in mind, right? Very simple ideas. When we analyze business transactions, there is a give and take. Finally, accounting is what? Accounting is recording business transactions. And in every transaction, there is a give and take. We give something to take something back. And as this process unfolds, we find what we have given and what we have taken in every transaction. And accountants keep on recording these transactions. Finally, you will realize that whatever has been given or taken is something which is relatable to these 7 concepts or 7 ideas. So we'll be taking a few examples, to really go to the bottom of it. But keep this in mind that a transaction involves a give and a take. So let's build on this. Now, when we give something in the form of money, it creates an outflow because money is going out, right? But at the same time, the cause of that outflow must also be recognized. It could be either meeting expenses or to create new assets or to repay a liability or to return a part of the equity to equity owners in the form of dividend or buyback. Again, these concepts, these 7 ideas are absolutely applicable to us as individuals also, except that in case of equity, there is no issue of shares to anybody. The equity at a personal level is nothing else but our accumulated savings. But except that difference, every other concept equally applies at a personal level as well. So whatever I just said applies at a personal level. When we are actually paying money, we are either meeting expenses at a personal level or we are buying some new thing like a television, new television set. So it's creating an asset, or we are repaying a liability when we are paying an EMI, or we may be even kind of acquiring some financial assets like investments, right? In our case, there is no question of we paying any dividend to anybody. So that's the only difference. So what we are giving is that we are giving money. So there is an outflow of money. And what are we taking? We are either taking an asset or we are taking a resource for immediate consumption. So we can call it as an expense, or by paying money to a bank towards the loan that we had taken earlier, we are actually getting a discharge of liability or discharge from a liability from that bank, because the bank is saying, hey, to that extent you have repaid my loan. Or in case of a company, we are also discharging our obligation towards equity owners by way of paying them dividend or buyback. Again, you can explore my videos. I have a video on buyback as well. So essentially, there is something that is going out from us, which is money, but we are also taking something back, right? Similarly, when we receive something in the form of money, it creates an inflow, but the cause of the inflow must also be recognized. It could be an income earning activity because of which the inflow is happening, or it could be by sale of an asset which we are wanting to discard now, or it could be raising a fresh liability, or it could be an equity infusion. So what we are taking is money, and what are we giving? If we are selling goods, then we are giving goods or services, right? If we are selling an old asset, then that asset is being handed over. If somebody is paying us because we had supplied goods earlier, then we had a claim on that party to the extent we had supplied the goods. So it was an asset for us, and we had created a claim on that other party. So when that party is paying us now, we discharge that party from our claim on them. So that discharge is being given back to them. And also, when we are taking a fresh loan, right, or we are taking fresh money as equity in the context of a company, then we have to acknowledge that liability or acknowledge that ownership interest to those people. So what we are giving to them is not in the form of money, but a recognition, an acknowledgement of liability, an acknowledgement of equity owners' interest in the company. So it's a subtle idea, but think about it. If necessary, pause the video before you go further. Think about it, listen to it again if necessary. But I know you're smart, so we can move on. So just like there are transactions which involve money, there can sometimes be transactions which do not involve any immediate flow of money. This is because goods are sold against credit also. So for example, we are selling goods. So you can see there is a give arrow where we are selling goods or services, or we are handing over an old asset which we want to scrap now, but they want to use it. And against that, we are not getting money immediately. But what are we getting? We are getting a promise from that party to pay in future. And therefore, in a sense, we are now creating an asset for ourselves. So an asset has got created in the form of that claim on that other party, which we can also call as receivables, right, or outstanding. And what have we given? We have given goods or an old asset. Now, similarly, there could be a situation where we are receiving goods today, right? Just like in that earlier example, we gave goods. Here we are receiving goods, or we are receiving some services. So expenses are getting created, or we are acquiring a new asset like a laptop. But we are not paying money immediately. We are giving a promise to pay in future. So we are creating a liability, right? I'm also bringing those terms, 7 terms here, so that you are able to associate how every transaction gets mapped to those 7 ideas, right? Inflow, outflow, asset, equity, liability, and so on. So I'm just trying to rekindle that association in your mind. Now, some transactions could have part payment and part promise. So that can be also interesting. For example, take the situation where we are receiving goods or services from a vendor, right? So either, it could be in the form of expenses, or it could be a new asset which is getting created. We are partly paying to the vendor, right? So there is an outflow, as you can see in the uppermost arrow. But we are also simultaneously giving a promise to pay the balance in future, and that creates a liability for us. But remember, we are giving that promise to somebody. We are giving something. It's not that we have only given to the extent of the money. We are also giving a promise. Like I have talked about my other videos in detail, but even money is what? Money has an underlying of promise itself. So do explore that in greater detail. But the point is, business revolves around promises. So we have to recognize transactions which involve full or part promises. Similarly, there could be sale of goods on our part, or we are selling services that gives rise to income for us. But we may not be collecting the full amount right now, or we may be even discarding an old asset, right? Because we want to replace it with new, and somebody else wants to use it. Like we sell a used car, somebody else will use it for a few more years. What do we get against it? We get some inflow, but it's not full. We are getting partly in the form of money, and the other part is coming in the form of a promise to pay in the future. Now, whenever we are receiving a promise from somebody else, or in other words, that other party is acknowledging our claim on them, we are actually creating a financial asset, like what I have already explained to you. Now, very quickly, these 7 ideas, where do they get mapped? Income expenses get mapped to statement of profit and loss. Inflow outflow get mapped to the cash flow statement. Assets, equity and liabilities get mapped to the balance sheet. So we are now getting idea about this framework. So there are 7 ideas. Those 7 ideas either can be flow or stock, and they can be mapped to 3 financial statements. And these are the 3 financial statements which get reported to us. So the objective of this video is to also give you that flavor of how the financial statements arise from raw data. Of course, this is not going to be a very sophisticated exercise, but enough to give you a very good feel of how things emerge. And in fact, it will also answer your question, why does the balance sheet balance, right? So we are going to look at that whole thing as we go along. So simply stated, just to repeat, every transaction impacts 7 ideas. Those 7 ideas are mapped to financial statements. So if we look at transaction by transaction, think about which of those 7 ideas or 7 concepts that this transaction is impacting, and then we know that these 7 ideas map to 3 financial statements, then we can easily find out how financial statements arise. So let's take a pause before we go further. I hope this 25-30 minutes were useful to you to do a quick overview of these ideas. Now what I'm going to request you is to download the 2 files from the description box of the video. One is a Word document which has the exercise, right? So you can look at that exercise. And then there is another one which has Excel, which is an Excel file, which we are going to use for populating the data. But we are going to do it together so that you also have a good feel. Now this is something even qualified chartered accountants will find as a very novel way, right? So feel free to use that in your own teaching if you are teaching any courses. But again, as I mentioned earlier, don't hesitate to give due credit where it is due. Thank you. So let's now move on. Okay, now a few observations about the Excel file that you have already downloaded. With respect of the financial statement, you will find some values with zeros appearing there, and to make it easier for you, I've also highlighted that in yellow color, right? So that you know not to tamper with them, because there are some formulae there, right? So what is the logic of those formulae, right? If you see the P&L, there is a net profit number where there is a calculation done to arrive at the profit figure. This profit figure is derived as the difference between income minus expenses. You can check the logic of that formula, right? But once this net profit is derived, you can see an arrow which is taken to the equity owners, right? And therefore that net profit is linked to the equity part of the balance sheet. Equity, as I had already mentioned, is nothing else but the money contributed by the investors and the profits which have accumulated over the years. So if you don't distribute the profit, and in this example that I'm going to do with you, I have not brought in the complication of dividends. So all the profit belongs to the equity owners, and therefore it becomes a part of the equity. You can again pause the video if you like, observe those financial statements for a while, and then again start the video. Similarly, if you see the inflow outflow part, which is of course a part of the cash flow statement, right? Inflows, after they are listed, they are all total. That total is carried to the other side, which is the outflow side, and then the closing balance is derived. So that closing balance is nothing else but the difference between inflow and outflow, and of course the opening balance, if any, at the beginning of the year. But I'll deal with that opening balance part as we go along. So whatever is that closing balance in the cash flow is again going to go and land into the balance sheet. So that's the reason why balance sheet is considered as a very important statement. It in fact provides continuity for the firm's financial statements from year to year, because The statement of profit and loss after the net profit is derived gets closed. The cash flow statement, once the closing balance is derived after looking at the opening balance, inflows and outflows, gets closed, and that balance in the bank's account gets carried to the balance sheet. So everything finally lands into the balance sheet, and this balance sheet becomes the starting point in the next year. So I'll explain this aspect again at a later stage. But let's now get going with the exercise. I hope you have already now downloaded both the Word document and the Excel file. So what I'm going to do is that from that Word document, and in fact you can again take a pause, read that Word exercise, which is about a company which is recently set up. So this is the very first financial year, and a number of transactions summaries are given to us. Obviously, hundreds and thousands of transactions happen in a business. So if we were to go through each one of them, it would be impossible for us to do this video. So you will find that there are summaries which are provided, summaries of sales, summaries of administrative expenses, summaries of other expenses, and so on, right? So summary data is provided, but the logic which applies to summaries equally applies to individual transactions. So this exercise will give you a very good flavor. So once you have read the exercise and observed the Excel files, you can start the rest of the video, and then now we can go together to populate the data in your Excel file. So for your ease now, don't worry about the Word document because all the transactions I have brought into this video itself. But you have to focus on your Excel file where you're going to populate the data along with me, right? Also see the logic of totals and how balance is derived, so you can observe them, right? Now what we're going to do is we're going to take a one by one transaction and record its impact in the respective 7 buckets, and those 7 buckets are already mapped to the 3 financial statements. So if you are dealing with an expense, it has to find a place on statement of profit and loss. If you are dealing with an outflow, it has to find on cash flow statement, and every transaction involves give and take. So it could be partly on P&L, partly on cash flow statement, partly on P&L, partly on balance sheet. So we'll see the logic as we go along, right? So this is going to be very interesting. Feel free to pause the video again at any point of time, right? So through a public issue of shares, the company has raised 50 crores. So this money has come into the bank's or into the company's bank accounts. So you would agree with me that the issue of shares would create share capital on the balance sheet of the company, and this share capital is a part of the equity, and we put 50 crores here, and it also creates an inflow of money. So on the left hand side you can see proceeds of issue of shares, and you can populate 50 there, right? Now because of the linkages in the Excel file, you can even go and check the balance sheet time and again to see whether the balance sheet is balancing, because the balance sheet has gateways coming from statement of profit and loss and from the cash flow, and everything lands onto the balance sheet finally. So the balance sheet has to balance if you have recorded a transaction fully. So you can keep on checking that. And then of course finally I will also share with you a PDF file with the final picture of how those 3 financial statements look like. So you can also download that PDF file, finally to cross check whether the answer that you have got matches with the PDF file or not. So that's something you can do at the end, but don't leave the excitement of constructing financial statements by yourself, right? So let's move forward. Then the company also raised a loan of 100 crores from financial institutions. The loan is repayable over a period of 10 years with a moratorium of 2 years for principal repayment. That means while it is repayable over a period of 10 years, for the first 2 years there is no repayment involved. Now whenever you have a loan of this long-term nature, it is classified as a non-current liability within the liability. Again, I'm not getting into those details. They are available in my detailed videos, so you can check those, but you will find a line there called as loan from financial institutions, and you can put 100 there. And also there is a cash flow because we have got money by way of loan, and that must appear in the cash flow statement as loan proceeds received. So you can populate it there as well. Now, on this loan, there is an interest of 11 crores, which is accrued for that period ended March 31, 2021. But contractually, the interest would be falling due only in the financial year 21-22 for actual payment. But the principle of accounting is that if you have used up a resource, account for it even if you are not paid for it. So interest expenses have to be recorded in the statement of profit and loss as 11, though we are not paid for it. But because something we have availed of but not paid for it, we have to also recognize that as a liability. So on the current liability portion of your balance sheet, because this will have to be paid within the next financial year, put 11 against interest accrued but not due. We'll move on. Now, what has this company done? With the money raised from public and financial institutions, the company has purchased plant and equipment worth 80 crores. So the same has been put to use immediately. So you have bought an asset worth 80 crores. This will appear under non-current assets. Non-current assets are assets of a long-term nature, and the balance sheet assets are classified into non-current and current. And in the non-current, you will see a title, plant and equipment, where you can put 80. And because the money has gone towards payment for purchase of machinery, it will have to be reported as an outflow, and you can report that 80 there as well. Now, there is this concept of depreciation on this machinery. The machinery which costed us 80 crores can't be shown as an expense for the very financial year in which we bought it, because it would be unfair on that particular year, because we're going to use the machinery over a period of 10 years, right? So therefore the data tells us that we have to account for 10% depreciation of the original value, and 10% of 80 comes to 8. So we report in the statement of profit and loss depreciation of 8. And in the balance sheet below the plant and equipment that we have reported 80, there is a line called as less accumulated depreciation of 8. So 80 minus 8 becomes 72, which is the net fixed assets after reducing accumulated depreciation. Now, this is the first year, so the depreciation and accumulated depreciation are exactly the same. But in the second year, the depreciation in the statement of profit and loss will again be 8, but in the balance sheet it will accumulate to 16, because 8 of first year and 8 of second year, and the net fixed asset value would come down to 64. That's how it continues from year to year. Now the company has 100 employees, so annual employee cost is 10 crores, which is in the form of salary. So salary has to be reported in the statement of profit and loss, and because it is told to us that it has been fully paid for, it has to also be reported under the cash flow statement as payment of salary of 10. I think this was straightforward. Now we have an interesting example which has 3 legs in it, like what we saw some of the transactions. Now the company has incurred some administrative expenses like rent and consumables, printing, stationery. The total expenses are 6 crores. Out of this, expenses worth 1 crore are yet to be paid. In other words, 5 crores have been paid, right? Now remember, in the statement of profit and loss, the entire 6 crores will have to be recognized as the full administrative expense, irrespective of whether we have fully paid for it or not, right? Because we have used that resource. In the balance sheet, what we have not paid will appear as a liability under creditors for expenses, and under the cash flow statement, you have to report the entire payment towards administrative expenses, which is actually paid for, which is 5. So now we can see that what we have taken is worth 6, what we have given is 5, and we have also given a promise to pay to those vendors. So there also we have given something, and that promise has to be recognized as the liability till it is actually paid off. Now during the year, the company purchased raw materials worth 150 crores. The company has not paid for the entire material purchased. 30 crores is yet to be paid to the suppliers, right? So again, here we find a 3-legged transaction. Now here I must clarify that those of you who are watching the video who work for large companies, the transactions are not recorded this way. This I'm taking in a very simplistic way. In large companies which have ERP systems like SAP, every purchase of raw materials is not treated as an expense on the statement of profit and loss. it is rather treated as an asset on the balance sheet in the form of inventory. And because they have sophisticated systems to record the consumption, as and when the material gets consumed, it is put into the statement of profit and loss. But here, I'm taking a very simplistic view of, say, a simple organization which does not have an ERP. So what they do is they record everything as a expense first. And to the extent they find at the end of the year, when they're going to report the financial statements, that the materials have not been consumed and there is a stock which is lying, they actually recognize the stock at that time. Whereas sophisticated companies first recognize stock and then recognize consumption as it happens. So that is a small nuance I thought of just mentioning. Again, going back to our simple way of recording it, so purchases will go into the statement of P&L of 150. The 30 crores which are yet to be paid to the suppliers will be reported under the balance sheet as vendor payable of 30, and the actual payment which has happened will get reported in the cash flow statement of 120. Now, interestingly, as I was just mentioning, out of this material, 25 crores worth of material is still in stock. So now, obviously, I have to report the right consumption in the statement of profit and loss. Expenses are resources consumed. So we need to report the correct consumption, and the entire purchase of 150 is not the consumption. So from that 150, we reduce the closing stock of 25, then we get the net consumption. So complete that 125 also, but remember, this closing stock is an asset for us as on the date of reporting the balance sheet, and therefore, you have to also report that as a part of the assets of the organization, which is the inventory or closing stock. Again, whenever you feel required, you can take a pause and then continue. Now we are told about sales data. Here again we find that there are three legs to this summary. Company has been able to notch up sales of 175 crores, but the total amount is not recovered. What is recovered is only 155 crores, and 20 crores is yet to be collected. That 20 crores yet to be collected is our claim on our customers. I'm sure you would agree with what I'm saying. So sales of 175 will have to be reported even if we have collected only 155 as of now. Whatever has been contractually delivered to the customers will have to be recorded as sales. So sales of 175, collection of receivables comes in the cash flow statement of 155, and whatever is not yet collected becomes our claim on the customers. So we can call it as dues from customers. Some companies call it as receivable, some companies call it as outstanding, some companies call it as trade receivable, some companies call it as debtors or sundry debtors. All these mean the same thing, that we have a claim on the customer, and that is to the extent of 20. So now let's move forward. Now the company has also received some advance to the extent of 5 crores, right? So this advance from customers is not actually a sale, you will agree. Sale can be recognized as sale only after we have delivered the goods that we were supposed to deliver. We have not delivered them as of now. We only got an advance. So we have to recognize that as an advance from customers to the extent of 5 as a liability on the balance sheet, and this liability will get squared off only when we deliver the goods. If for some reason we fail to deliver, we'll have to return this money to the customers. And it will also appear as a collection in the cash flow statement, right? Now we are gradually coming to the conclusion. If you have already populated the data, now we are the last piece of the exercise is, there is one more, but almost towards the end, is the tax calculation of income tax. Every company is also required to pay corporate income tax, just like we are required to pay at a personal level. This is not GST. Remember, GST doesn't appear on the financial statements because the company is typically acting only as a collection agent of the government, right? So in the final statements, you will not find GST unless there is some dispute which has happened or some litigation. But otherwise, the tax that we are reporting here is the income tax. Now we can see, if you just see the Excel file, you will find that the profit after tax currently appears to be 15. Is it actually profit after tax? The answer is no, but because Excel doesn't know about it, it has simply kept on populating that number based on the formula. So we know that this is profit before tax, and let us say that the tax rate is 30% to make it simple. So 15 into 30% is 4.5. Let's round it off to 5 so we don't get into decimals. So we have to report this tax cost on the statement of profit and loss. Indirectly, tax cost is a cost because the company also uses a lot of public goods, roads, airports, ports, and like infrastructure. So it's a cost paid to the government for creating these public goods. So that tax is reported as an expense under statement of profit and loss, but because it is not yet paid, it has to be also reported as a provision for tax on the liability side of the balance sheet, right? Okay. So now we are also told that the company is enjoying a surplus liquidity because they already raised money by way of equity and loans, but they have not yet fully embarked on the requisite capital investment or expansion. They only did some part of it, so 80 crores of plant and equipment, but they will be investing again. So this surplus money is now parked under a short-term time deposit of 65 crores. So it's like an investment for us, for the company. So on the balance sheet, the short-term investments are reported as 65 crores, and the cash flow statement, we would also report the payment towards that short-term investment. So that also comes as 65 crores. Okay, now check the final numbers on the balance sheet. The total of equity and liabilities is 2 and 2, and also assets are 2 and 2. So you're convinced that balance sheet balances. It is not an unbalanced sheet. So I hope you enjoyed this exercise. I have a few more things to share with you before we conclude, but I'm sure it would give you a very good feel. Do check the final numbers that you have populated in the Excel file with the PDF file, which I have also shared in the folder. So you can also download that and just cross check to ensure that you have got all your answers right. Friends, I also want to share with you that financial statements work as a system. We have already seen how they are interlinked with each other. Now, the missing piece in the example that we solved was the balance sheet at the beginning of the previous year, because this was a new business. So we had only three documents here: statement of profit and loss, cash flow statement, and the balance sheet at the end of the current year, right? But typically what happens is, for the same company in the next year, there will be a starting balance sheet at the end of the previous year, and that captures the entire history up to that date. So that would become the starting point. And then in that context, the statement of P&L and the cash flow statement plus the new transactions which would have happened during the year, all that will be accounted for. And then the balance sheet at the end of the next year would be prepared, right? Now, the limitation of the exercise that we just did was that because we were doing in a very simplistic way, I had to assume that we had a zero starting point. In real life, there will be a starting point in your own organization because of the continuity which would have happened over years. So in that case, this Excel file that we just worked on will have to be modified to take into account the starting point and then the transactions during the year to arrive at the balance sheet at the end of the next year. Statement of profit and loss and cash flow would be reasonably straightforward, but the balance sheet preparation would have to have a link with the balance sheet for the year which has already concluded prior to that. So we have done this exercise for year one. So while preparing year two, year end one balance sheet, right, will have to be taken as a starting point while preparing the final balance sheet for that company at the end of year two, and so on. And that's why balance sheet is the continuity. Finally, why in real life accounting looks complicated? Here we took summaries of transactions, so we could finish the exercise in 40 minutes. In real life, transactions are happening every moment. Plus, numerous transactions are happening. The variations are also very many. Here we could assume some 6-7 types of expenses, but in real life, there are hundreds of expenses. And again, we break them down into cost centers and zone and location and all that, right? So that obviously makes it tougher. So in real life, there is what is called as chart of accounts, which details expenses into hundreds of heads, assets into hundreds of heads, liabilities into hundreds of heads, right? There will be multiple bank accounts. So all that has to be handled in real life. Also, as I mentioned earlier, there is a continuity from previous years. So your accounting system has to be geared to handle the balances at the end of the previous year and make a link of what is happening during this year with those, and then reflect the balances at the end of the current year for which accounting is being done. But the purpose of this exercise was very much to give you a flavor of the interconnectedness, how the financial statements arise, and I'm sure that objective has been served. Finally, the real life is complex and we can only model it to make it simple and just to understand the basic principles. But in real life, once we understand the principles, we have to align with the reality. So, which all of us do as managers or entrepreneurs or executives, right? I think kindly look at this exercise from that perspective. So for more such videos, do explore our channel, and it was nice to have you in this journey of 50 minutes in which I have tried to succinctly explain how financial statements emerge. Do share this video and do explore other videos as well. Thank you very much.